Welcome back to Investing Talk Podcast.
Good to be here.
Today, we're taking a look at the trade desk. We've got some material here giving us a snapshot of the company around early June 2025.
Looks like financials, business factors, some recent news.
That's right. So our goal is to unpack all of this performance, market position, strengths, risks, the outlook.
Sort of piece together the story from what we have here.
Before we jump in, if you find this helpful, please do subscribe, like the episode, leave a comment, maybe even consider buying us a coffee. Links are below.
We'd really appreciate that. Helps keep the lights on, you know.
Okay, so the trade desk. Let's start with the financials. What are the recent numbers telling us?
Well, the latest quarter covered seems to be Q1 2025. Revenue hit $616 million.
$616 million. How does that compare to the year before? Is that strong growth?
It is, actually. Pretty strong. The Q1 2024 number was $491 million.
Oh, wow.
So yeah, that's a 25% increase year over year. Shows real momentum recently.
Okay, 25% growth in Q1. But I feel like I remember reading something about the quarter before that one, Q4 of 24. Wasn't there a bit of a stumble?
You're right. Q4 2024 revenue was higher, $741 million, but that's typical for Q4 ad spend.
Right. Seasonality.
Yes. But the issue was it apparently came in slightly below expectations. Missed guidance a bit.
So a Q4 miss that got some attention. Then they follow up with 25% year-over-year growth in Q1. Kind of a quick rebound on the growth rate itself then.
It looks that way, comparing year over year. And the bigger picture, looking back over several years, they've consistently shown double-digit revenue growth.
And where's that growth primarily coming from?
A lot of it, these notes suggest, is really powered by connected TV, CTV, and also mobile advertising. That's where the ad dollars are increasingly flowing.
Makes sense. What about profitability? Revenue is one thing, but is it translating to the bottom line?
Good question. The Q1 2025 figures show improvement there, too. GAAP diluted EPS was $0.10.
Okay, and how does that compare?
That's up from $0.06 in Q1 2024. And then there's the non-GAAP number, which often gets looked at closely.
Right, stripping out some items.
Exactly. That non-GAAP diluted EPS improved, too, from $0.26 in Q1 24 to $0.33 in Q1 25.
So both measures are heading in the right direction. Up year over year.
Correct. It indicates that profitability per share increased alongside that revenue growth in the first quarter.
Now, there was something else mentioned about their financials that really jumped out. Something about debt.
Ah, yes. That's quite striking. The company reportedly had zero debt as of early 2025.
Zero debt. For a growing tech company, that seems unusual.
It is quite unusual. It means their balance sheet is incredibly clean. Very little leverage, if any.
And why is that such a positive thing? I mean, sometimes debt fuels growth.
It does, but zero debt means massive financial flexibility. No interest payments weighing them down, no principal repayments to worry about. It's a position of strength, especially if the economy gets choppy or if they want to fund something new without borrowing. It gives them options.
Okay, so strong recent growth, improving profit metrics, and this remarkably clean balance sheet. Sounds like a solid financial foundation.
Fundamentally, yes. The numbers suggest strong operational performance and a very sound financial structure.
Let's move on then. What exactly is the trade desk? They're called a leading demand-side platform, a DSP. What does that mean in plain English?
Okay, so think of the online ad world. You have sellers of ad space, publishers, websites, streaming services, and buyers, advertisers.
Right.
A DSP is the tech platform for the buyers, the demand side. It lets advertisers and their agencies manage their digital ad campaigns automatically. They use it to buy ad space across websites, video, audio, and, importantly, connected TV.
So it helps them buy ads smarter.
Pretty much. It uses data to help them target the right audiences, optimize how much they spend, and track performance, all trying to get the best results for their ad budget.
And what gives the trade desk its edge? Why would an advertiser choose them over another DSP?
One key thing mentioned is their tech platform called Kokai. It's described as proprietary. And the idea is that Kokai enhances how they do programmatic advertising, that automated buying and selling. It supposedly makes it more effective, especially in those key growth areas like CTV and mobile.
Is that the super fast automated bidding?
That's the heart of it, yes. Kokai seems to use advanced data analysis, maybe AI, to make those split-second buying decisions better. Get the right ad in front of the right person at the right price.
The materials also talked quite a bit about how they compare to walled gardens. What's that about?
Right, that's a crucial difference. The trade desk operates on what's called the open internet.
Meaning?
meaning they help advertisers buy ads across thousands of independent websites, apps, and streaming platforms. This is different from the walled gardens think that giant tech platforms like search engines or social network.
Where they control everything.
Exactly. They often control the audience, the ad space, and the buying tools, all within their own closed system. The Trade Desk positions itself as offering access outside those walls, across the wider internet.
Providing more choice and maybe transparency.
That's the argument. More reach beyond any single platform, and potentially more objective data because they aren't selling their own inventory primarily. This open approach is framed as a big plus for advertisers.
Interesting distinction. So where do they stand in the market overall? Are they a leader?
They're definitely positioned as a leader, or at least a major player in the ad tech space, especially for independent DSPs.
Independent meaning not owned by one of those giant platforms.
Correct. And some commentary suggests they might even gain more market share, perhaps if competitors like Google face more antitrust scrutiny. That could push advertisers towards independent options like the Trade Desk.
Okay, so they've got technological strengths, a model that contrasts with the tech giants, and they're riding the CTV wave. But it hasn't all been smooth sailing, right? What are the challenges or red flags mentioned?
Definitely not all smooth sailing. The most visible challenge is probably the stock price performance recently. Over the past year, it's noted the stock fell significantly, something like 50%.
Ouch, 50% is a steep drop. Was that just the wider market dragging tech down?
It seems to be a mix. Broader economic factors like inflation and rising interest rates certainly played a role, as they tend to impact advertising budgets.
Makes sense.
But there were also company-specific things. That Q4 earnings miss we talked about seems to have hit hard.
How hard?
Well, the notes say after that report came out on February 13, 2025, the stock dropped over 30% in just one day.
Wow. Okay, so the market reacted very strongly to that miss and maybe the outlook given then.
It certainly looks that way. Shows how sensitive the valuation was, perhaps.
And looking forward from that point, even with the good Q1 revenue growth, were there other concerns about future performance? Profitability, maybe?
Yes. While Q1 revenue grew 25%, the forecast for adjusted EBITDA in that same quarter was actually for a decline, about 10%.
A decline in adjusted EBITDA. Why, if revenue was up strongly?
The reasons given are tough comparisons to the previous year's Q1 and, significantly, increased investments.
They're spending more.
Investing in what? Infrastructure, hiring, building for the future, basically. But that spending impacts near-term profitability. And looking at the full-year forecast, the adjusted EBITDA margin is expected to be lower, around 39% than it has been.
So investing now, which is potentially good long-term, but it's squeezing margins in the short term, and that's making some investors nervous.
That seems to be the dynamic described. A slowdown in the rate of profit margin expansion is definitely flagged as a concern.
What about valuation? You mentioned sensitivity. Is the stock still considered expensive even after dropping 50%?
Apparently, yes. The commentary suggests that despite the pullback, the valuation is still seen as high compared to peers or the broader market.
So it still trades at a premium.
It seems so, likely because of its historical growth and future potential. But a high valuation can limit how much the stock can go up, especially if growth slows or the market remains cautious. It adds risk.
Any other specific risks? Legal issues, maybe?
There was mention of a class action lawsuit filed against the company and some executives,
Oh, what's that about?
alleging potential violations of federal securities laws. We don't have details on the substance or merit, but lawsuits like that can create uncertainty and overhang for a stock.
Okay, so let's summarize the challenges. Tough macro environment, a big stock drop after a specific earnings report, projected lower margins due to investment spending, a potentially still high valuation, and some legal noise. Quite a few hurdles.
It is. It shows a company with strong underlying tech, navigating a difficult period, both externally and internally, due to their own investment choices.
Right, so let's flip back to the positives. What are the key strengths and potential catalysts that could drive things forward, according to this material?
Innovation is definitely highlighted as a core strength. They're described as continually investing in their advertising platform and ecosystem.
Any specifics on recent innovations?
Yes, there's mention of a new application called Open Sincera, set to launch around June 6, 2025.
Open Sincera, what's that designed to do?
It's aimed at giving advertisers more visibility, more transparency into how their ads are performing, and the overall health of the ad supply chain they're buying from.
So doubling down on that transparency and open internet angle we discussed.
Seems like it. Plus, continued investment in enhancing that core Kokai platform is also noted.
Any other company news? Management changes.
There was a note about Vivek Kundra joining as Chief Operating Officer, announced back in March 2025. A new COO can definitely bring fresh perspectives or execution focus.
Okay, so new products, potentially new leadership focus. What else could act as a catalyst moving forward?
Future earnings reports are going to be absolutely critical. The market will want to see proof that the investments are paying off, that growth remains strong, and what the guidance looks like.
So execution is key.
Absolutely. Successfully rolling out things like Open Sincera and showing continued gains, especially in CTV, could really help rebuild confidence and act as positive catalysts.
So the bet for the bulls is that this investment phase and innovation pipeline will power through the current challenges.
That seems to be the positive case presented, that the long-term strategy and tech advancements will win out, assuming they execute well and maybe get some help from market conditions.
Now, thinking bigger picture, industry context, what major trends are helping or hindering the trade desk?
The biggest tailwind mentioned is definitely the continued shift to connected TV. As more people stream, more ad money follows, and the trade desk is well positioned there, expanding partnerships with streaming platforms.
And the demand for transparency you mentioned.
That too. Advertisers increasingly want more control and clarity in how their money is spent programmatically, which aligns with the trade desk's open internet positioning.
And who are they really up against in this fight?
The main competitors highlighted are the big ones: Google's marketing platform, Amazon's DSP, huge companies with vast resources.
Tough competition.
For sure. But again, the trade desk's strength is framed as being the leading independent option, constantly innovating in CTV and audio, trying to offer something different from those integrated giants.
So it's the independent innovator versus the ecosystem giants?
That's a good way to put the competitive dynamic described here.
Lastly, what's the overall vibe, the sentiment towards the trade desk right now based on these materials? Analysts, market chatter?
It really seems mixed. Some analysts are quoted seeing it as a potential buy, especially for the long haul, maybe seeing value after the stock's decline relative to its growth prospects.
But others are more hesitant.
Correct. Others are focusing more on those macroeconomic risks, the near-term margin pressures from the investments, and maybe still finding the valuation a bit rich.
So a split opinion.
Seems that way. And that division is apparently reflected in online discussions too, places like Reddit or X. You see arguments for both the long-term potential and the short-term risks. The overall summary seems to be maybe a fit for patient, long-term investors okay with bumps, but caution advised for the short term.
Okay, this has been really useful pulling all that together. So to recap, we see a company with strong underlying revenue growth and recent profit improvement, a very clean, debt-free balance sheet, which is a major plus. They've carved out a strong position with their tech, especially Kokai, and their open internet model, riding the massive CTV wave. But they're facing headwinds, macroeconomic pressures, significant stock volatility linked to that Q4 miss, planned lower profit margins in the near term because they're investing heavily, a valuation that some still see as high, and that class action lawsuit adding some noise.
It's definitely a complex picture. You have clear fundamental strengths meeting real market and operational challenges right now. The tension between those two is palpable in the materials.
For sure. It gives you, the listener, a much deeper perspective than just the headlines, showing that mix of solid foundations and current pressures. So here's a final thought to leave you with. The trade desk is clearly betting big on its technology and innovation, investing heavily to capture trends like CTV. How effectively can they execute on that roadmap, deliver on that tech promise, when faced with unpredictable external forces like shifting economic conditions affecting ad spend or potential new regulations popping up in the ad tech world? That balance between their internal execution and those external uncertainties really seems like the key thing to watch based on everything we've discussed today.